Let's bring in Nick Colas, co-founder of DataTrek Research. Nick, welcome. Good to have you with us. There are lots of hotspots around the world. Today, you can add Kenya to it, riots in Nairobi. You've got geopolitical risk. You've got U.S. political risk. You've got quite a stew to roil the markets between now and certainly our election day and maybe beyond.
Yeah, absolutely true. We're hearing this from clients both in the U.S. and in Europe. They're very happy with the year-to-date gains. They understand where the market is and why it's here. They appreciate NVIDIA, obviously, but they're looking at the summer with a bit more concern because we have less liquidity, less trading, people are on vacation, and that's the backdrop we often see for a summertime surprise, a negative summertime surprise. And the U.S. political situation is probably the first on deck with the debates on Thursday.
Yeah, absolutely. It could change things one way or the other. But you're not suggesting that there are problems intrinsic to individual companies as such. In other words, the profit picture looks pretty good. The economy is growing reasonably well. Spending seems to be okay.
All true. I think that the issue with the market right now is the market is perhaps not complacent is the right word, but they're looking at the market as relatively stable. So we look at sector correlations to understand how confident investors are, and they're exceptionally low right now, which tells us that we're probably in for a bit of a waiting period for the next month or two. And any of these summertime surprises we're talking about could be what upsets the market in the short term.
So on the energy trade, Nick, which is getting a little bit more interest, especially during NVIDIA's big correction there, down 15%, why do you think that might have legs or should be an area that people should consider having exposure to?
Yeah, you're right. Energy was the big winner since the NVIDIA highs last week and has been rallying back on higher commodity prices, but also I think an understanding of the geopolitical risks that we're talking about. Our standing advice to clients, and this goes back the whole 7 years we've run DataTrek, is never be underweight energy. And perhaps having to have a small overweight because it's the only thing that works during a geopolitical crisis that increases oil prices quickly. So if you go back to, say, 1990, August 1990, the biggest summertime surprise in the last 40 years, Iraq invades Kuwait, energy prices spike, the market declines, energy stocks are up 10% over 10 days. They were the only hedge in a geopolitical crisis that created an oil spike. So we're always cognizant of that risk and always tell clients, stay focused on it.
I certainly get the idea of using energy as a hedge against geopolitical issues, but how, in periods where there were not those sort of proximate geopolitical events, how has energy fared? My sense is not all that well.
Oh, very interesting point, because if you go back and look at how energy's done, say, since the end of 2019, so the whole pandemic and post-pandemic period, energy on a total return basis is the second best performing group since the start of 2020. If you include and reinvest dividends.
I'm very surprised to hear that.
Tech is number one. Tech is number one. Energy is number two. So the key, though, is you have to reinvest those dividends. Very important point. If you just take the dividends and invest in something else, you don't do as well. But if you're reinvesting your dividends in energy, it does quite well. So it holds its own.
On that, not sort of slice things here, I also wonder, is nat gas kind of the new oil? Because in a lot of what we've seen in recent years with Russia, I mean, and that's obviously specific to Russia, but it had massive gyrations, whereas, oil was kind of surprisingly stable. Nevertheless, more broadly, Nick, do we talk kind of growth versus value, or is that a waste of time?
For right now, unfortunately, it's a bit of a waste of time because growth has just taken over the world because of tech and NVIDIA. And the only thing you can say about growth is look at large cap growth as S&P 500 growth. It's now 60% in the top 10 names. So there's a lot of concentration in popular growth approaches. So I say like the S&P 500 has become a growth portfolio. So you don't really have to go over too far into the S&P growth index to get that growth. You get it in the S&P without that concentration risk. It may seem bad in the 500. It's even worse in S&P large cap growth.